How are you, folks? Enzo DiCostanzo, clinical professor of economics and finance in St. Peters, New Jersey City. And today's our third personal consumption expenditure video. So let's get right to it. Okay. So, yeah, so we've been getting through the notes in the again, folks, I apologize for that odd sound. Yeah, we've been getting through the notes in the personal consumption expenditure reading, and where are we? We're here. Yeah. So the audits, hopefully you're working on that this week. This is the week of the 24th, or I'm sorry, the week of the 14th, November 2022, November 14th, Monday or Monday, Tuesday. So you're getting through these. This is a good week's worth of lectures just right there. Here's part one. Part one is there. Part two is there. So we'll have an article, a little bit of definition, and then a little bit of Excel. Okay, so you had these two that I posted, a couple of days ago, and the reading for the final exams. I think this is the first video since that. If you just go to syllabus and schedule, and you go to final exam, you'll see the readings right there. Okay, and you'll find this. You can find this in those readings. Just search for Fed lifts rates by 0.75 points. Again, this was the 5th meeting in July, so we're going to talk about the notes from that. And let's just begin with this thing. Fox News had a nice graphic as to where we were with this in terms of, I think it was 3/4 of a point increases. So we're up to 2.25 to 2.5 federal funds rate. And again, this is what the commercial banks lend their reserves to one another. And again, it's a little more of an advanced topic, but just as we've spoken about in previous videos, there's a big impact on anything that has an interest rate, credit cards, mortgages, car loans, home loans. Yeah, anything like that. Treasuries, what the government lends money at. Okay, what the federal government, the Treasury lends money at to raise capital for the government. So that impacts anything with an interest rate, basically. But markets rallied after the meeting and offered few specifics about the magnitude of upcoming rate increases and hinted at an eventual slowdown. Well, I mean, look, he's mentioned over 2022 that their intention was to keep raising until inflation lowered. And again, I think there was an example somewhere along the line. I don't know if it was in one of the videos, but certainly I think we had 16% inflation in the early 1980s and 19% interest rates. So, it's got to be a little bit above. And if we're at 8% now, you can sort of, I think they're hoping to slow down inflation 5 or 6% and not have to go to, higher numbers. But we'll see. We'll see how that goes. But and this whole thing about markets rallying with a higher interest rate. Yeah, we had the interest rate video, the notes somewhere in the mid semester where we talked about the definition of interest rates and how it impacts just spending, consumer spending, business spending, all those kinds of things. And if you're spending more to cover your debt expenses, you're spending less on employees, you're spending less on development, you're spending less on capital expenditures. Okay, so that's the sort of the aim of a higher interest rate is to slow down economic activity. Now, if you look at the bottom here, it says, well, markets rallied. Markets rallied means the markets, okay, now we know what at least until the next Federal Open Market Committee meeting in 6 weeks or whatever it is. Now, actually, okay, yeah, so we're in November. They skip August and then go to September. And then I think it's November, December. Yeah. So if this is the 5th one, there's 3 more. So it'd be September, and it skips October. But that's certain. And what happens is that August meeting, it's not so much Federal Open Market Committee, but all the economists get together, I think, in Wyoming. So there is a sort of an informal meeting, not informal, but it's maybe an informal Federal Open Market where they don't make necessary policy, but you can believe it's being spoken about. But there's a certainty as to what these rates will be for the next 6 weeks until the next Federal Open Market Committee. So that's why you see markets increasing a bit, but still, we're still down pretty good from January. And it says the S&P gained about 3%, and yields on the Treasury note fell a bit. So now, when the yields on the note, what it means when there's a couple sort of forces at work here, and I've spoken about this in previous videos. When you have the yield in decline a bit, or the yield is shrinking a bit, that means that the notes are more expensive, which means there's more capital piling into these debt instruments where you're certain for the principal payment, you're certain for the annual payments, or this every 6-month payments, or this whatever the period is, the semi-annual payment, or whatever it is your payment schedule looks like. you're paying a higher amount of capital to buy those payments, and that's why the yield shrinks. Okay, so there's more. So obviously, as interest rates increase, there's an expectation that obviously the Treasury or the federal government is going to have to borrow at higher rates. So more capital chases that to lock in those higher returns. That's why you have that increase. And so always just keep that in mind. And certainly when in terms of these gains, again, there's more capital piling into the equity market also. And it's not just a one for one. You can see there's more capital piling into both of these, into fixed income instruments and into the stock market or the equity instruments. Okay, there's still capital piling. It's not, it leaves one and then goes to the other. It doesn't really work that. People, when I was in business school, I sort of thought that. Okay, but it doesn't really work that way. It's based on the interest rates, and it's based on demand. It's based on all that. So Mr. Powell gave insistence that the Fed has to cause slow growth and accepts rising recession risks to bring down inflation. So that's been an echoing theme for quite a while. And he says it's a bit surprised that all assets reacted in such an exuberant manner. As is Michael DePass, head of global linear rates trading at Citadel, okay, which is the big Chicago hedge fund that's recently moved to Miami. And it's interesting, linear rates. You can see these guys have a lot of math guys working there. I've never seen that title, global head of linear rates. I've never seen that title too often. And more likely ahead. So this happened in July. We had a meeting in September. There's a November meeting happening. So we're looking at all of those. Those results will be in other Wall Street Journal articles, but there's certainly been increases, since this one. It's certainly higher than 2.25%, 2.5%. That's for sure. And as Mr. Powell said Wednesday, it's too soon to say whether the Fed will dial down the size of the rate increases to 0.5% or 0.25% at the next meeting in September. But at some stage, it'll be appropriate to slow the pace of rate and assess the impact on the economy. See, that's where I think we're just a little bit more. We have our fingers on the pulse of it a little bit more than maybe we did 40 years ago. It says these rate hikes have been large and they've come quickly. And again, the Fed's 4 consecutive rate increases since March, and it's likely their full effect has not been felt by the economy. So there's some significant additional tightening in the pipeline. Well, does he mean the pipeline of the economy or the pipeline of increasing interest rates? I don't know what's really clear about what he means by that, but he says there's probably some significant additional tightening, which means I hope that he means in the economy where the effect of all these, the 4 previous interest rate increases have been are going to be felt. It takes a year, it takes 6 months, it takes 12 months, 18 months, 14 months for the impact to hit corporate performance, to hit balance sheets, and to hit how the companies are doing. Because people, okay, well, the Federal Reserve changed interest rate. On Wall Street, people move relatively quickly, but if it's some industrial company somewhere, its movement might not mirror how fast a hedge fund in New York or a hedge fund in Miami is going to move compared to a company out in the rural America, out in rural Pennsylvania or something like that. The Fed chairman says the slowdown in economic growth during the second quarter has been notable, cooling of consumer spending, hiring, housing activity. And again, we can look at those particular numbers. Now, with the consumer spending number, we want to look at our model. So he's talking about the second quarter of 2020. So we have the personal consumption numbers here. Okay, we're at the top of this thing. This is the 2.8. This is 2020. So, and obviously, this is real personal consumption expenditures. This is goods, services, durable goods. These are the monthly readings. So, and if we're in Q2, is it slowing? Well, let's see. Is that slowing? 210, 272, 302. Well, not really. Okay, we don't really see it slowing there. Yeah, well, and again, it's probably, these numbers are very it's price times quantity, creates this number. And if prices keep increasing, the weight of that is going to outweigh if there's a quantity decline in the aggregate of these numbers. So I'm trying to validate somewhere what Jay Powell is talking about, and no, I can't validate it anywhere. Yeah, everything is up in the second quarter. And it's up from a year ago. I'm looking here. It's also up from a year ago, too, pretty much. We were here at 14 trillion, 14.2, 14.3. So that's not really, I'm not seeing that. yet, but maybe he's looking at maybe a different measure, maybe he's looking at an index or something. Here, let's look at some of the indices and see. Even though we're still working on the monthly numbers here, and actually here's the dollar change from the preceding month for personal consumption, durable goods, non-durable goods. Those are all the indices that are here. So let's look at how these are changing. Yeah, these are the deltas. July had a little bit of a decline. There some sporadic declines here and there, but not some gigantic numbers. The top line number doesn't seem to be going down, Stanley. Right, the top line number doesn't seem to be going down too much. Right, we're in the second quarter here. There's a slight decline here. That would be 900. There'd be 100 million. That'd be $100 million decline right there. July, there's a little bit of a top line decline there, but he was talking in here. So this, I don't know if these, now he may have had these numbers while he was giving the press conference or answering the questions. He may have had, so yeah, looking here, there are a bunch of negatives there, and he may have had those numbers before the public did, which is not a terrible thing. Here is inflation slowing in Q2. Not really. Inflation's not slowing. Maybe in Q3, maybe a bit. Okay, but not in Q2, right? Not that much. Because up to 7, it was 6.8. But now it's 6.2, so it's down a bit. So again, you have to be careful what these guys. And again, these guys, when they're giving these comments, they may have those numbers before other folks do, before everybody else has. Hiring numbers. Let's look at the hiring numbers a bit. Labor statistics, employment. Labor force, population, earnings. Here's non-farm. And again, we're in Q2 with this. Again, let's look at second quarter. All right, yeah, I mean the add-ons are declining a bit, right? You had 500,000, 700, 400,000. Now you have 300, 360, 380, 300, but it's up again a bit. Let's look at unemployment rates. Unemployment, that's government employment levels, earnings, unemployment rate. So we're here with this. So the April, May, and June. Yeah, pretty much held steady. I mean, it's the unemployment rate is lower now. It bumped up here, but it's lower here. So I don't know if I'd really go with that. With those comments, spending, and then I don't have the housing activity numbers. Okay, but generally, obviously, I've been saying that for a number of years. I have to add those into my my set of data. But the Fed chairman said the slowdown in economic growth during the second quarter has been notable, citing signs of cooling consumer spending, hiring, housing activity. Okay, well, as we've seen the slowdown in economic activity that we think we need. All right, well, I hope so. Maybe he's also not quoting what he's referring to here. Powell suggested the central bank wasn't likely to slow down rate increases simply because the growth slows, because inflation is running well above the 2% target. The Federal, all the sort of intellectual minds on this want long-term inflation to be 2%, 1.8%, those kinds of numbers. It says not just tolerating below trend growth, but saying it's necessary now to put a different gloss on acknowledging the slowdown in spending and production. That's an economist, one of the investment banks. Okay. And the Commerce Department is set to report the U.S. GDP numbers, the broadest measure of goods and services for the second quarter. Economists surveyed by the journal estimate the growth to change or to appreciate at 0.3% at an annual number. And let's check that out. We have output, which is here. We had a decline, and what was this? It was estimating an increase, and we had two declines there, minus 0.6 and minus 0.6%. Okay, so we had a couple. So obviously that didn't meet that. You had a decline instead of an appreciation. It says employers have been adding jobs at a brisk pace, and employment rate is held at 3.6% at a very low level. The Labor Department is set to report on Friday the widely watched measure of wage growth. It could be especially important because the Fed is trying to reduce household purchasing power to slow inflation. So yeah, I have the wage numbers. Let's take a look at the wage numbers. You're here, the wage numbers, earnings, hourly earnings. So what are we looking at here? These numbers moved. Yeah, they're all positive, right? These are all positive. They're a little bit less positive lately, but not by much, though. Still, I'd say it's pretty. Right, and from a year ago, right? From a year ago, we're still up five. Okay, we're down about 4.98, but we're still just touching. And we've had some of the 4% numbers and the wage growth too from a year ago in 2021. So you know, but you can see where it started. It sort of started in April from a year ago, and just really never looked back. And this is wages. It's not necessarily an inflation measure, but it's wages. But okay. So, but this is trying to reduce household purchasing power and set of job growth and dismissing the concerns the economy is currently in a recession. Yeah, the reason the economists are saying this is because the you don't have a decline in employment yet. That's why the economists are saying that. Okay. And it says Jay Powell is more concerned about the risk of failing to stamp out high inflation than about the possibility of raising rates too and pushing. So yeah, so they're more concerned about runaway inflation than a recession. There's a Rubini from NYU is balancing whether it's going to be a soft landing where it's just reduced growth and people are still working, or a hard landing is a recession and people are the decline on output and a decline on employment. That's what Rubini's trying to balance those two. It says, but some investors say Powell's delicate delivery. That message also said the Fed doesn't think recession is necessary to bring down inflation, is undermining the policy. The whole point of a 3/4 point basis or 75 basis point increase to tighten financial conditions. 75 basis points or 0.75%. This is a founder of Pushing Square Capital Management. It says each time Jay Powell has raised rates, ironically, he's eased financial conditions because his unwillingness to acknowledge the Fed is prepared to take the country into recession in order to eliminate the. Yeah, so see right there, that kind of a comment. That's saying that even though you're making a definitive decision on interest rates, but you're not really giving too much guidance to the future, your future behavior, and that lets people think that maybe interest rates won't be continued to be increased, and they still behave as though the interest rates will sort of level out at the number that there are now. That's really what the guy from Pershing Square is trying to comment on. It says Fed officials have been raising rates at the most aggressive pace since the 80s. Until last month, the central bank hadn't raised a 0.75% since 94. With Wednesday's actions, it says the central bank has raised rates since March as much as it did between 2015 and 2018 and returned the federal funds rate to a level last seen a couple years ago before slowing the economy led the Fed to cut rates slightly. Officials slashed them to near zero in March 2020 when the COVID pandemic raced around the world. And it's a time I think we don't like to forget, what happened in 2020, that's for sure. It says inflation has accelerated. And I think we just looked at that since March 2021. Demand has surged after the economy is reopening, and aggressive government stimulus and Russia's invasion of Ukraine has further aggravated the supply chain disruptions and driven energy and commodity prices up this year. So in three very simple lines, it's talking about a lot of things that are going on in the economy. Okay. So Powell reiterated the need to control inflation. The central bank raised rates again. So that we said already. And it says consumers and businesses responded to tighter money supply will help resolve one of the biggest questions facing the Fed and financial markets: how high officials will ultimately raise rates. And again, markets want to know what that is, and he's playing poker. Jay Powell is playing poker with that. So trying not to reveal too much of that. So hot inflation reading earlier this month, the consumer price index rose 9.1% in June from a year before. Let's check that. 9.1%. And yeah, this made the Fed look at the federal funds rate and potentially even raise it by a percent this week. Use a separate gauge for that. Okay, let's see if we could get the June number for this. June 7. Yeah, this is allegedly the year-over-year number. Right, that's the year-over-year number. Is that? And this is from a year. Yeah, that's a year-over-year percentage. It's down to 7 instead of 9.1. Okay, well, that's the index. And this is last year, the same time. Let's see that one. If that one's 9.1, it's not. Let's see this one. Yeah, this is just month over month change. This is month over month from the previous month. Okay, that's just the previous month. Okay. This is not an annualized number. This is just the previous month. This is 8.6. It's probably the 7 that they're referring to as a 9, but it's probably really down to a 7. It's probably this one. This is the nominal one, which is going to be higher. Yeah, this is the nominal index. This is just the month over month change, is all this is. Yeah, that's just month over month. And here there's no percentage here. So yeah, it's probably that 7, right? It's even though it says a 9, but again, these numbers have been updated a couple different times. And maybe the personal consumption expenditures are notorious for moving around a bit. Okay, but still, it's still high. I'd still say that's pretty high. So, okay, like I said, we have some general idea what it is, right? The consumer price index rose, prompting investors to expect the Fed increased by full percentage at the July meeting. Okay. And then it says investors in interest rate futures markets also betting that after rising interest rates around 3.5% at the end of the year, the Fed will reverse course next year by lowering it. Yeah, I like Dion. Dion's a reporter for the Wall Street Journal, and he gives very good videos. He's got a bunch of them up there, so if you guys can check him out, I'm sure. And I think he's from New Orleans. I think he's definitely Haitian heritage. He's a hard worker. And, you could see really a good guy, really good guy. And you could see he does a good job with the videos. Explains how we got here and how the Fed. Yeah, okay, so that's for another time. Powell said Wednesday it was too soon to say next year what the path of the rates will be, but he pointed to some projections. Showed the expected rate to be 3.5% this year and 4% next year. So they are giving some long-term guidance. Again, and the people were sort of, you have to do the research to know what that's going to be. It says market expectations of the rate cuts reflect a major misunderstanding of how the central bank is likely to react to slowing growth and rising unemployment with higher inflation. Said a founder of a hedge fund, Pantera. In recent years, low inflation, given the Fed's more flexibility to quickly cut rates and reaction to slow growth slowdowns. But officials don't have the luxury right now because inflation is high, and they're worried about consumers and business anticipating inflation to stay high. Economists, central banks believe the expectations can play a fundamental role in shaping the actual. Yeah. So again, what you think the next 6 months, think the next year is going to look like, can really influence your behavior, and that's in economics that we look at that all the time. Okay, there's no working age in America there's no one. Okay, there's no working age American who has traded bonds in a rising inflation environment. That's true. That's true. He thinks possible Fed will raise the federal funds rate to 5% or some number nobody can get their head around. Yes, what it means beyond the inflation numbers that we have now. Now again, no working age Americans. Well, I have a relative who was in New York 40 years ago and still working. So I don't know. Who knows? I don't know how statistics based that statement is. I think that's more of an emotional statement than I think I know what he means, but there's probably not many people around who remember the 80s, but they're around. They may not be on the floor of the exchanges, but they're in management at this point. That's for sure. The Fed has raised rates 0.75 of a percentage point last month, and several other central banks have accelerated their own rate increases. Investors have responded in ways that reflect growing worries about the recession. Oil and commodity prices have tumbled, and some market-based measures of future inflation and bond yields. Well, the oil prices. Let's look that up. How we're doing with that? Where is that? That's the U.S. Energy Information Administration, right? Yeah, this is usually good. Per barrel, okay, it's down a bit, but there's usually some good graphics here. The products coming from petroleum, projection data, prices. Yeah, this is based on the regions. Here we go. Um, okay, yeah, we're down a bit. Regular gasoline prices were down, but again, there's suspect reasons for that. It was what in California, Rocky Mountain, Gulf Coast. Where are the U.S.? It's hard to get the U.S. number. This number's sort of right there. Hard to navigate something like this. Rocky Mountain is Colorado and stuff like that. West Coast, California. Obviously, those are the highest. Yeah. Oh, but you could see the pattern, and this is some kind of download of the chart content. Diesel fuel prices on highway. It is too. I always hate graphs that are too cluttered. But you can see the general prices from about a year ago. You can see what these are basically looking like. Okay, so even if you're down here someplace, obviously the U.S. is this blue one right there. We can't really hover over it. I apologize for that. But yeah, and again, the housing numbers, the oil numbers. There's just so much data we could talk about. So I've limited it to the Labor Department and the price indices, but I'll add as we go through the courses over the years. We'll add this too. Okay, you could see. I don't know if they're crashing, but you know, now again, is it what Biden? The games Biden is playing with the reserves, or is it just? I think it's just less demand. Is really what I think it is. So yeah, actually, here this is. I think this is what I was talking about. This is the paragraph I was talking about. Um, yeah, this is a good one. When we've seen this before, this paragraph in other places before. It says, the Fed funds rate, an overnight loan between banks, influences borrowing costs throughout the economy, including rates on mortgages, credit cards, business loans. The rate slows the economy, cools inflation by reducing asset prices and raising borrowing costs, which dampens inflation, hiring, and spending. There you go. Why do we care about this? That's why we care about it. Is that I'm laughing because the guys at work are always asking me this question: why do we need this? Why are you talking? Why are you always talking about interest rate? Why am I always talking about interest rates? So the housing market is one of the most interest rate sensitive corners of the economy. The epicenter of the Fed's effort to stimulate growth last year and to slow it this year. Prices have surged among strong demand, but sales are slumping now as rates. Well, and again, I'm not going to venture into the Census Bureau's number, but that's where to get the housing numbers is in census. But again, that's something else, another component I need to add to this as we go along. 30-year mortgage rates, the St. Louis Fed has these numbers, about 5 and 0.74% last week. It says last week, sometime in July, holding close to the 14-year high. The National Association of Realtors, which is a big industry group that I think you can buy membership in and all that, separately said that Wednesday that an index measuring the contract signed to purchase existing homes fell 8.6% in June. For May, it was 20% below the level from a year ago. All right, and again, that's an index measuring the contract signed to purchase existing homes. Okay, that's what these guys think. Right now, we've kind of gone from order takers to financial therapists as home builders. The buyer is a little bit of a shock. And again, it's always good some commentary from people on the ground. You know, a real estate agent, somebody who works for a realtor, and people who work in industry, or people who work in asset management, or some of these banks. You want to hear people who are there and are watching transactions happen every day, sort of what's going on. And the company said its cancellation rate, which measures the share buyers that back out of a purchase contract, hit 21% in June, up from 8% the first 3 months of the year. Executives said they were no longer providing guidance to investors on expected sales because we have no idea where the Fed is going to land. Well, that's not really true. With the Federal Reserve, it said it here. Again, the guy probably didn't read this article. They do know where the Fed is somewhat going to land. It's just you got to do the research to do that. Okay, so there's this article, and again, this is and oh yeah, let's go to the reading. I think I may have mentioned to you guys at the start of the video. Here, yeah, the final, yeah. So that you have to search for. Just type in the title. Fed's lift rate by 0.75 points again. Type that title in, and you'll find the readings in there. Okay, so you guys can go through that. So next time. All right, so we're a third through. And I want to talk about shocks, economic shocks. Which is here. All right, refers to any change in fundamental macroeconomic variables or relationships that has a substantial effect on macro outcomes and measures of economic performance, such as unemployment, consumption, and inflation. Yeah. Okay. So again, I don't know if these interest rates the movement in these interests would be considered economic shocks, but certainly you're going to hear that terminology in the NYU guy and all sorts of people, Jeremy Grantham. Yeah, they're going to talk about shocks a lot. Sorry to touch my nose, but the weather's changing I'm in the Northeast. The weather's changing, and obviously you're feeling it a little bit. The you can feel it in the air. It's cold outside, warm inside. It sort of causes your nose to get itchy somehow. I apologize for that. So variables or relationships that have a substantial effect on macroeconomic outputs, outcomes, measures of economic performance, such as employment, consumption, inflation. Shocks are often unpredictable, and the results of events thought to be beyond the scope of the normal economic transaction. Yeah, the unpredictable part, but the Federal Reserve, it's trying to be somewhat predictable by saying, hey, next year we're looking at 4% interest rate federal funds rate. It's saying that to sort of avoid, because these things are generally bad. Okay, a shock is generally a bad thing. They can have widespread and lasting effects on the economy. And again, but the 208, I'm not saying we didn't recover from the 2008 financial crisis, but at this point, how many years ago is that? That's, I guess, on its way to 14 years ago, 13, 14, 15 years ago, I guess, depending on where you sort of started looking at that. So, yeah, I mean, that's, and still, I think that the reverberations of that have still are still being felt. If you go, because just the specter of the potential bad news that all was. There's something called real business cycle theory. And really, if you look at, and I've spoken about this in class, if you look at recessions and you look at the business cycle, that's a big part of it. Okay. This is really the root causes of recessions and economic cycles, and really studying, output going up or down, employment going up or down, the behavior of interest rates, the behavior of housing, the behavior of oil prices, the behavior of the financial markets, what the S&P 500 is, and all these kinds of things. As you're now coming from a math world like NJIT, Rutgers, these kinds of places, there's always this idea, okay, we're going to develop an equation that's going to tell us how all these things move. Okay. And that's really tough. I think you'll get a lot more mileage out of this area of knowledge if you just look at the patterns, and without worrying about if you have an equation for this or that or not, you just look at what's going on. Is inflation going up or down? Are interest rates going up or down? Oil prices, housing, consumer spending, business spending, economic output, and looking at all those. If you can sort of arrange that in your mind or with an Excel model or something, I think you're going to get you're going to do a lot better with predicting sort of what's going on, and just looking at the conditions in the world and saying, hey, there's people need to live someplace. They might be priced out of housing, so they're going to start renting down in Miami. They're going to start renting out in Beverly Hills or whatever because the houses are too expensive, and there's only so much supply of rental space. And if you're an investor if you're an investor in investment properties and buying apartments, you're going to rent to people, or buying space, you're going to rent to people, that you're going to be doing relatively well. Then it's not going to be empty. There's more people in the country by millions and millions of people. There's more people in the country, that's for sure. So we're going to know that by the end of the Biden administration. I've computed the number. I'm not going to say it, but I've computed the number. It's a scary number. I'll tell you that. It's a scary number. How many more people are going to be in this country in a couple of years? But anyway, so economic shocks are random, unpredictable events that have a widespread impact on the economy and are caused by things outside of the scope of economic models. Economic shocks are caused by things outside of the scope of economic models, can be classified by the economic sector they originate from, or by whether they primarily influence either supply or demand. And because markets are connected, the effect of shocks can move the economy to many markets and have major macro economic impact for better or worse. Okay. So, yeah, so a shock is obviously the 2008 financial crisis was a shock. COVID was a shock. Those are shocks, to the system. All of a sudden, everybody stops working, or credit was freezing up, 14 years ago, or whatever was going on with the savings and loan scandals and the Great Depression. Really, the Great Depression was us getting our hands. Really, what that was the birth of an economy. That was a pregnancy, is what that was. That was a painful, traumatic thing that said, hey, you're going beyond an agricultural society. You're going to be industrial. You're going to be in banking and steel and transportation and railroads and airliners and aircraft. And unfortunately, there was a couple world wars right around those times. And that was the birth of the world, is really what that was. The world as we sort of know it today, and it sort of moved from there. Here's a couple types of shocks that you might hear some of the definitions of. So yeah, there's 5 of them: technology, policy, financial demand, and supply. And we'll go through those. Primarily impacting the economy through either supply or demand side. They also can be classified by their origin within or impact upon a specified sector of the economy. Shocks can be considered either real or nominal shocks. And you guys, the example that we're going to work on, the model we're going to work on in a few minutes, is going to be the I think it's the real model still of personal consumption expenditure, but there's a nominal one where the numbers are going to be a bit higher. The real one, there's a base year, reference price someplace. Is it real economic activity? Is it nominal values of financial variables? Markets and industries are all interconnected in the economy. The large shocks to either supply or demand in any sector of an economy can have far-reaching macroeconomic impact. Shocks can be positive, negative to the economy, though for the most part, and normal people, they're more concerned about the negative shocks. Now, here's sort of, I don't know if this is maybe a terrible example, and my mom's going through this right now a bit too. She's getting some treatment for something rather serious, and she's not doing chemotherapy. And she's holding steady. She's holding pretty good right now. But if she was maybe 45 or something instead of 98 or whatever it is that she is, she's going to be pretty soon. I guess she'll be 98. 90, yeah, or 97, 98. Wait, it's 26, 23. So 26. Yeah. Okay. So right, she'd be 3. Yeah, she'll be 97. 97. Wow. So now, so supply or demand in any sector of the economy can have a far-reaching macroeconomic impact. So again, anybody who's had cancer treatments or anything like that, you go through chemotherapy or an operation, you're cut into. There's other parts of your body that are affected with the chemotherapy. So it can really sometimes our doctor's the kind of a person just let it run its course, and so far that's been pretty good. So we appreciate that. Can be positive, negative to the okay, fine. So, well, you can think about it in the medical sense, or you can think about it in the economic sense, or what have you. Or again, we've seen this before. Down the shore, whatever it might be, people want to build a nice house. They buy the property. They buy a house on that property. They don't like the house. They knock that house down, put a new one up there. That's a shock to the property, a shock to the system down there. And there's a new house sprung up. So after all the tearing down the old place, there's a new place, which in their mind is better, right? Better. But here, let's look at the 5 shocks, then we'll hit the model. So here, the first one, supply shock, is an event that makes production across the economy more difficult or more costly. A rise in the cost of important commodities such as oil can fuel prices to skyrocket, can cause fuel prices to skyrocket, making it expensive to use for business purposes. So again, anybody who's bought a box of crackers, 12 eggs, milk, right? We're all seeing that it's a pricier venture to do all that because it's costing more for all those trucks lined up in the Walmart parking lot to get there. A natural disaster, weather event, hurricanes, floods, major earthquakes can induce supply shocks too. Can man-made events such as wars or major terrorism incidents, obviously what's going on in Ukraine, sometimes refer to most supply shocks as technological shocks. Okay, right. Well, maybe. Sure. Okay. But again, less natural gas on the market, less oil, those kinds of things. Okay. That's supply shocks. Demand shocks, when there's a sudden considerable shift in the patterns of private spending. And all of a sudden, no one has, the banks all shut down. So we potentially could have been looking at a demand shock, right, 14 years ago. Or, less investment spending, less people investing in investment real estate, things of that nature. An economic downturn in the economy of a major export market can create a negative shock to business investment and export industry. So if all of a sudden whatever's coming from China, we stop buying that, right? So their export market is our import market. So that's a shock to the Chinese market because we're not buying from them anymore. Okay. And Trump was sort of almost trying to create that with higher tariffs on Chinese products or Mexican products and things of that nature. Things were created in those countries. A crash in stock or home prices can cause a negative demand shock as households react to a loss of wealth by cutting back sharply on spending. So, a buddy of mine is always asking me about rental markets and real estate and what I think. And I'm trying to explain to him that what really matters is, okay, fine. Look, my parents bought the house that we live in, for $50,000 40 years ago, something like that, right? Now it's worth easily 10 times that. What matters is if you're engaged in a transaction. If you're not transacting, then it shouldn't really mean too much. Since it's real estate prices are crashing. Well, what does that really do to you if you're not selling your house or buying another house? Now, if real estate prices are crashing and you're buying a house, that's a good thing. But if you're trying to sell your house in a crashing market, that's a bad thing. But if you're doing neither of those, I'm not saying it's okay, but you're not going to be as impacted as people who are engaged in transactions while these things are happening. It's like saying, well, the Atlantic Ocean is rough. Well, if you're standing on the beach and you're not swimming or surfing, what does that really do for you? But if you try to go swimming or surfing in very rough waters, of course, you're going to be impacted by that. Okay, that's a demand shock. So Yeah, household direct loss of wealth. Some people are like, oh, how much my house is worth. There's people, the Italians love to do that. The Italians, we love that. Talk about how much our house is worth. Supply shocks to the consumer commodities with prices. And inelastic demands means you have to buy. You have to buy like food and energy. You have to buy those. Can lead to demand shock by reducing consumers' real incomes. Economists sometimes refer to demand side shocks as non-technological shocks. Okay, well, you go find these other words for these different versions. The financial shock obviously was 208 and other the same as loan crisis from the 80s and the Great Depression and the stuff that happened in the 70s and the early 80s, right? From the financial sector of the economy, modern economies are deeply dependent on the flow of liquidity and credit to fund normal operations and payrolls. Financial shocks can impact every industry in the economy. A stock market crash, a liquidity crisis in the banking system, unpredictable changes in monetary policy, or the rapid devaluation of currency are examples of financial shocks. And financial shocks are the primary form of nominal shocks, though their effects clearly can have serious impact on real economic activity. Okay, that's that one. I highlighted liquidity in the banking system because that's what I'm working on right now. And actually, what we need to do is we're just sitting here. Um, this is the data, the Bureau. This is just type in bea.gov. That's good. And we're going to get to this in a second. We want the interactive data thing. I just wanted to set us up to get to that. Policy shocks, changing government policies like Trump. Again, Trump creating tariffs. Trump is creating a couple shocks, policy shocks, and depending on which side of the border you're, let's say with Mexico, all of a sudden Trump raised tariffs on all the products coming out of Mexico. That would be a supply shock on the well, it'd be a supply shock for us, for the Americans, and then be a demand shock for the Mexicans, saying, "Hey, people aren't buying our things because it's more, our goods. It's more expensive." Okay, and on top, on top of the tax policy of that, so government policy of profound effect. The economic impact of a policy shock might even be the goal of a government action. It could be the expected side effect or an entirely unintended consequence as well. Fiscal policy is in effect a deliberate economic demand shock. Positive or negative and tend to smooth out aggregate demand over time. And all of a sudden, we start really a policy shock. Everybody getting transfer payments during COVID, whatever Fox News has the graphic, trillions of dollars of government spending over the last 2 years, whatever it may be. That's even though for us, we say, hey, we like that. And, the consumer may the taxpayer, the citizen may enjoy that, but it's still a policy shock. It's a good policy shock for us in a sense, but it also may have caused a lot of inflation, which is a negative of that. But here it says the imposition of tariffs, other barriers to trade can create positive shocks for domestic industries, but on a negative shock to a domestic, who again, there's multiple parties or multiple sides of the effect here. Is it consumers? Is it producers? A shock to one is positive shock and a negative shock. Positive shock to one or negative shock to the other. Okay, you have to always sort of sort through all that. Sometimes even a potential change of policy or an increase in uncertainty about the future policy can create an economic shock before or even without an actual policy change. Again, the specter of what are interest rates going to be, and we've had a bunch of videos about that. And our last one is the technology shock, which results from technological developments that affect productivity. The introduction of computers and internet technology resulting in an increase in productivity across many different occupations is an example of a positive technology shock. Economists often use the term technology in a much broader sense, so that many of the above examples of economic shocks, such as a rise in energy prices, would also fall under the category of technology shocks. However, people often refer to shocks specifically originating from the technological sector you got to be careful with that. All of a sudden now, new operating systems, or now this is big 20. The nanotechnology idea was big 20 years ago. I don't know. I haven't followed how far that's come, but that was a whole new regime in terms of creating these semiconductor chips and memory chips and communication chips and microprocessor chips. It was a whole different manufacturing process, a whole different set of science, and that would be a big deal. And it renders all of those companies making the equipment for the manufacturers and the people who are experts in that science, it renders them somewhat useless in that respect, unless they can transition to the new knowledge. And if you ever met college, these scientific guys in these universities, they don't have a gigantic interest in changing their research interests. So you always got to keep that in mind. Okay, so we talked about a couple, and again, these notes are in the reader, so you guys can spend a little bit of time on this. On the final exam, we'll be spending some time with the shock idea, the economic shock idea. Is that's an important piece of the puzzle. And I just want to make sure, because I don't think I spoke about that stuff. I should have checked before I started talking about it, but let's see. What are we doing here? Audit, fine. Yeah, no, this was we did the two parts of the personal consumption expenditure. Yeah, so we didn't discuss shocks. So what we're doing today, the economy. We talked about the Wall Street Journal article. We talked about shocks, and the last thing we're going to do is we're going to deal with these tables, and we'll get the data, and we'll start building up these tables, and then you guys can watch the replay of the Washington Philadelphia game from last night, right? Where the Eagles were 8-0 and Washington beat them. Now the Giants got to play the Eagles twice, or the Redskins twice. Actually, they got to play the Redskins and the Eagles twice. I haven't played any of those teams, and there's another game coming with Dallas. So we have 5 games, and we have Minnesota. Or if we can go 3-3 in those 6 games, I think we'll be in good shape. But we'll see what happens. I think the Giants will surprise. I think this is one of those years where I just think that they're motivating the lower end guys and not the $19 million a year guys to really excel. I think that's really what's going on here. So anyhow, we'll get back to that. So all right, so we want the personal income piece of this, interactive data tables. Section 2, and this is 286. Now this is the monthly numbers, and actually here, this is the now again, this is the student Excel sheet. Just go to PCE right on the Blackboard site, and we already worked on. We have the quarterly model. We didn't do that yet, but the annual model we worked on last time. Actually, we worked on 2 of them. We worked on the real and the nominal one. So it's the same kind of a thing, really. It's just this stuff all over here. Why is this grayed out down here? What is this? Why this is gray, but residual. I think that's great to say, hey, that's not that important. I think that's why we break that out. Anyway, we're not working that right now. So, and the notes are in here too. The PCE notes are in here. What the Bureau of Economic Analysis is, that those notes are in there. What personal income is. We're not going to hit personal income yet either. But these are the monthly models. Is what we're going to work on next. What we're going to do is we're going to download table 286, and we're just going to work on the various versions of this. This is measured from the same month last year to the same period this year. These are the monthly changes, and yeah, so this would be a percentage here. Yeah, this stuff is a percentage. Yeah, these are percentages. These are month over month percentages. So it's a month over month change, and we do a little exponential math on that. And then this is the month over month, previous month of the same year. Some of these are in dollars. Some of them will be in percentages. And then, yeah, this is the dollar change from the preceding month. And then we're here. So, and actually what we'll do, yeah, we're going to work on all those. There. So you're there. Okay. So you're here with this. All right, let's download this table. We'll do the monthly table going back to 2019 is what we need to do. So we're here. Let's modify. The initial year is 2019. Now, what I notice is if you convert this to millions, you get a little more precision with the numbers. Well, let's not worry about that right now. But you can do that. So, okay. So I adjusted this to start in 2019. So 1920. So it's 4 years. It's about 50 columns of data, but these are just listings. Down here, there's addenda. These are just listings of these numbers in in United States dollars and billions and chain dollars with a reference price somewhere. Here, we're going to add up durable goods and non-durable goods to get goods. We'll add up services and get the personal consumption. So I almost just said the model as we're talking. Now, if you want to project, you just take the average dollar. There's so many ways you can do it. You can take the average dollar change, average percentage change, and just project a year out or 2 years out. But when you do a projection, you want to project the durable goods under just these 3. You don't want to project. I mean, you can project the top line number, but you want to project the components and then add them up. So you'll be projecting these 3 lines, all the 5 down here, and then this you just do the math like it's just like you already have the data, not like it's projected data, but it's actual data, not projected data. That's just something to keep in mind. Hit download, and download is an Excel file. You can open up the table. And here, let's start with the addenda first. Now, again, you're managing 50 columns of data or so. So you want to keep that in mind. So here, let's gotta go to editing. So here, none of these are going to be added up here. And these are the indices that are created up to September, but maybe the methodology might be different, or it's just this is just the food component. This is just energy and goods. This is PCE. Now, I guess what should happen is these should add up to that. I've never worked it out, but here we can mess with it right now and see how we do with that. So this you want to anchor it right, even though you're gonna have to move it around a little bit. You want to anchor it right in there. We're gonna do paste just the values. Okay. And then you want to take these last two, copy, and you're gonna paste those, just the numbers in there. And here, open this up a bit. Oh, whoops, trying to avoid that. All right, you have this. Delete that. And okay. So for for better or worse, you have to bear with me while we do this. You just have to go through and just again, I'm going to do this whatever 40 times. So just be patient while we do it. And that, every once in a while, I have one that does it a little too big. So when I double click on the vertical border here, I'm just telling Excel to widen the cell to the widest component of what we have here. Okay. Again, it's a little monotonous and a little tedious, but hey, welcome to model building. When it does that, you could just undo it yourself a bit. Hey, we're just opening these up a bit. Okay. And then save. Okay, so I don't know. Let me see. Copy, paste, some. Let's see if that gives you that same number up top. It might be. I think I just noticed it. It might. 12,929. About. It's you'll see these are about those numbers. Yeah. Then you go through border, 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 border. Okay. Yeah. So you took the PCE and then it took out food, energy because into components. And again, these are notorious sort of all over the place. And then you have a market-based PCE. And I don't know how are these not market-based? I don't know. But maybe there's a different methodology to getting these particular numbers, which could be that could be what's going on. Actually, the border's got to come down a bit. Oh, these are italics and maybe make them a bit smaller. Okay, it's like a little bit of a check is what then we'll put it here. Check down center. Okay. All right, that's you just dropped in durable goods. So what do? I copied and then just cut and paste. But again, I cut and paste 50, 50 columns of data. Okay, which you guys probably aren't used to doing too much of that. Now the goods line, this is just simply the summation of the bottom two. All right, you can copy this. Volt HV formula. That's just the formula. That's about $4 trillion. Okay, and then now the drum roll for the top line number are all of these added up. Cover the border. Open this up a bit. Yeah, I mean, these numbers are these numbers are almost the same somehow. It's weird that happened there, but that doesn't usually happen though. I mean, they're close. They're close, these numbers, but it's not. I wouldn't say it's very close. So you got to be careful. Okay, and then once you have these, you can do a couple things just to sort of preserve your borders. Like that. And you can leave these other ones. You can leave those sitting there like that. Of course, I apologize. I should have realized that the bolds weren't going to. I'm gonna have to repeat it for the. But I want to be able to read the numbers. What are we talking? We're talking about 13 trillions of dollars. Okay, so this is what we have, and then save this. Okay, 14 trillion. Yeah, the summation of those sort of is pretty good. Okay, like I said, well, this was a check. We just added up those, and again, look at the formula. See, where it says equal sum AS 19 colon A. So what we're doing is saying, column AS, row 19, row 20, row 21. When you put a colon in, it's the endpoints of that 19 to 20. So it's 19, 20, 21, including those endpoints. Very mathematical thinking there. And this is just the summation of all the inputs, the goods inputs and the services inputs is all that is. Okay, so that's just your data. You're starting there with your data. That's it. So we have however much data we have. There are 50 or so pieces of data. Okay, so that we have. Now, some of these, as you roll down, we're going to create some of these other tables. They're tables that you could also just find in a press release or something. But you want to be able to to work on the to understand what's going on too. All right, and this is measured from the same month of last year to the same period this year. Okay. So these changes these are rates. Okay, these are rates. So you can't worry about 2019 because you have 2018. But what you would do is, and especially just for the top line numbers, you're going to take this reading, the January 2019, the annualized reading, which means it's just for the year. That's how the markets would behave. That's not 13 trillion in a month. That's 13 trillion in a year. And if the year behaves that month, so you get the PCE that would move 2.8%. But we're still reasonable. We didn't know the pandemic was coming yet, although some people I think did. Right, and I'm just controlling right. right? So obviously you could see pretty good, and then boom, minus minus 4% in March, April minus 15%. So we've seen these numbers previously, right? We've seen these numbers previously. Yeah, here we are. Okay. Yeah. So this is just a straight percentage change, is all this is. It's nothing more than that. So see Alt T. Okay. You take this March, subtract it from last March and March a year ago, and then divide by the older March number. And here, actually, what you can do, you can say copy, and you go all the way through to September Alt HV formula. Just bring the Alt H, just bring the formula here, just copy, and you do paste, cancel, paste, formula. That's it. And this is formulas and formatting, but we're just doing formula. You can see how again the dollar measure how it changed in 2021, up 11%. So you had big increases that correspond to a lot of the stimulus spending in 2021. And then you can see a lot of these numbers are quoted in the article that we referenced as we were reading the articles. Now we're creating the tables, is what we're doing now. But we've referenced a lot of these numbers as we created as we read the Wall Street Journal articles. Now, and none of these add up or anything, so you can't really work with that. But what you can do, so you might say, Professor, man, I have whatever 50 columns or 40 columns or 30 columns and 7 or 8 lines. How do I do this? Well, you can copy that formula because you didn't anchor anything. You can slide down to goods, durable goods, the whole story here. Now up one right there. You can say Alt HV formula. Right, now what this does is without doing really any thinking, it lets you, as you go down your categories here, goods, durable goods, you can do all the computations on these next lines without worrying about because everything's listed right under each other, so you have to worry about do I have this right or whatever, because it's generally going to be good. So you're going to copy these, and we're already formatted. Everything's already formatted, and you're going to go right across Alt HV formula and then hit escape. You can see now it worked on the component percentage change, which some people say, hey, I'd rather know the goods number or the services number, because this is services, this is goods total. Okay. And then you can go down. Obviously, some of them there's going to be bigger impact than others. Okay. Durables really dropped off the face of the earth. Non-durables not as much, because you had to buy food, you had to buy gasoline. Okay. And you can look at the patterns of these. And again, I'm giving this as sort of a wide brush thing, but there's so much. I mean, we're doing an hour and a half lecture here, but there's so much you could do here with these numbers. Okay. And then the next thing is the addenda here, 56 to 62. Actually, here, what you can do, you could say Control D, and then just delete all the divisions by zeros are just spaces. Right? So now you took the component pieces, the PCE without energy, you did all those. And again, this is all pre-formatted. I'm saying yours, you have to work on the formatting yourself, Alt HV's the formula. Okay. And you're there with this. And that's it. And you could check any one of these, right? What do? You took a current year and then a previous. Actually, that's the check we did. We did the check. Actually, the check line, we should make this italics, right? Because this is just a check, and make it a little bit smaller. That's just a check. And save, as you go along. You want to say, and like I said, the more of this that you can do, the better you're going to perform in a bank or, some kind of, higher role. This next one is you're going to take, and it says how we're doing this. It says measure from the previous month of the same year to the current month, and then you're going to annualize it. And I'll show you what that means. Let's take the top line. Now we can't compare 2019, but here, let's just use this. So equals parenthesis. So you're going to take February minus January. You're going to divide by the older number, And the percent change you're going to get this one is about, this might be a bad one. This is about 0 or whatever. These are small changes. We could see 0.3, 0.6, whatever it might be. So here, let's work on the 0.6 one. Excuse me, folks. Excuse me. There's a couple things you could do here. Certainly, this is just the month-over-month change. Here, let's look at 2020. And there's a little more exciting numbers here. Again, the January number generally doesn't change that much. Minus 12% change, 9.3% change. So looking at these numbers, the general change in this number is going to be, what's it going to be? The general change could be, a 0.5% a month, or maybe less, maybe 0.25% a month, something like that. If you multiply this 0.3 by 12, you would pretty much get what I'm going to show you in terms of how to alter the numbers or how to change this, how to do some exponential or some geometric mathematics on these, basically how to project that number over 12 months. If you multiply it by 12, you get a similar number, but we're not going to do that because we want to be fancy with the math. Okay, so what we're going to do, instead of multiplying by 12, we're going to do the following. We're going to go into edit mode. We're going to click right there, right, and say parenthesis 1 plus, and put another set of parentheses in front of this, and then a third set, and we're going to say to the exponent 12, and we're going to subtract 1. Because what you're doing is you're taking 1 plus the rate, multiplying it to the 12th power, and then that equals 1 plus the rate for the year, then subtracting the 1 to solve for R. Pardon me, folks. That's what you're doing. And when you hit return, you can see, now, obviously with 0, you're not going to get too much of you're not going to really see too much with this. But if you look at some of these other, see all of a sudden now, it's a little more of an annualized number. So here for June 2019, 4%. And here we don't have it, but 4% is about what this moves, 4 or 5%, something like that. So you're getting these reasonable numbers. Now, they're going to go off the charts a bit next because we had such odd, we were in a shock. We were in shock territory, right? But if you just take the formulas in there, see, even February, 3.4 here. February's 3.4, 3.1. This was the change from a year ago. This was an annualized change. This is 0.2%. This is whatever this was. Okay, 2.8. So that was, but see, some of them are going to be different. Some are going to be different. And here, let's get out of 2020. Let's go let's say July 2021. Minus 2.2, okay, 7.8. See, because the behavior is just based on a month change. The August 3.5, 7.6. Okay, that's so yeah, it's blown me out of the water. Yeah, 6.5. See, some of them will match up. October 9.4, 7.1. Okay, but and then in the journal, who knows what they're referencing? But I usually go for like the 3%. Yeah, the 3, 1.6 are close. 2.2, 1.8. Some of them will be close. Like I said, so what you've done is, and you look at the math here, you've annualized your number. So what you've done is you've taken the month-over-month change and you convert it to an annual change. That's really what you've done. Like I said, some of you are going to get this, some of you aren't. What are we going to do? We want you to be able to understand it, all right, as best you can. And once again, the same thought process here. We're going to copy the formula. We're going to say goods all the way up to our September number, Alt-HV formula, and then escape. And again, if you look at the formatting here, it's percentage, centered, all that. Okay. We're going to take this number, we're going to drop it down, and then delete all of our empty lines. And even the top one, you have to worry about the top one. That's just that's just your check. And then you're going to come across Alt-HV formula. Okay. I'm just fixing the borders a bit. Yeah. All right. So that's this one. That's the up here. This was from a year ago, and this was annualized. You can, some of them can be different, right? 6% and 2/10 are very different because you're basing it on 1 month's behavior and projecting for the year, but that month may not represent the whole year. Okay, that's really why they're so different. That's the sort of the math reason. Well, it's really the data reason why that they're so different. Okay, and actually, this is table 7. Yeah, there's press releases with this stuff, and I didn't verify them now, but in the past I verified them. See what's this table 7 up here, and the press release from the Department of Commerce. They'll have these things up there as some, not the whole thing like I do, but they'll have some of the tables up there. Okay, this is previous month of the same year. Whoops. Yeah, this change, I have to see. I don't think this is annualized, right? This next one. Yeah, this is just without actually, maybe should have done this one first. This is the month over month change, uh, but just without annualizing the numbers. So you're going to go up here, 2019, up here, subtract this, divide. Okay. That's just the month over month change, right? So 0.63, and actually just let me check. Yeah, 0.63. Yeah, these are just the month over month changes is all these are. Minus 0.3. Yeah, all that. This we don't need. There we go. Okay, again, the same story here. And you go all the way across your latest bit of data, Alt HV formula. And it takes the components and does the same math on the components. And then you can do the same thing here. Right there. You have all those and copy. Alt HV formula. Oops. Across the whole spectrum of places here. So this is just the month over month change, is what this is. Right? Yeah, this annualized number minus that annualized number. Yeah, there's a table that looks at that as a percentage, and then I think the next and last one is going to be the dollar change, and that'll be it for today. Yeah, and that'll be the last one. We did this wasn't too long, right? This has been an hour, right? 2A, and the last piece of this are the dollar changes from the previous. I mean, you can do the component method with this. So I'm just going to do everything from top down. I'm just going to do it like that. But you could do the component method too. This is just the dollar change, right? And then you can say copy. Now here, just to save some time, let's just do the whole Alt HV formula. And then what you do is all the places that don't deserve a number, just quickly, you can just run through them, bleeding. Okay, some of them are blue, which shouldn't be because I just kept the same sort of color scheme, but obviously these are all computations. But this is just the dollar change. So this is 11 billion, right? This is 200. Yeah, this is 200 million per the net negative 200 million on this one. This is minus 11 billion, minus 900 million. Okay, positive 19 billion is what that is. So yeah, see, look at this. Excluding food and energy, this thing went up 19 billion. But this personal consumption for food and energy just went down a bit. So, like I said, so you had and the food numbers, the gasoline numbers, whatever it might be. Okay, so you got to just be mindful of that. So these are just the dollar changes. Is all this stuff is, and then this just in one sweeping blow here, Alt HV formula, and that's it. And like I said, you can take the you can take the press release, and actually here, while we're here, let's find the latest press release, just as we're talking here. It'll be it's one of these two. Doo, doo, doo. These are the indices. These are the chained. Yeah, we might be able to check like one line here. So let's see. What are the tables that we have here? Additional information. This is all personal consumption, and these are expenditures. Table 7. Okay. Index. So yeah, 7 and 8 or 7. We could actually table 7. We could just look at 7. But here, let's look at the summary up here. Yeah, let's just check everything that we can while we're here. All right, this is the cover page. All right, we can't do indices today, but we could do these two lines. We could do these here, and we could check what these look like. Percent change from the preceding month in 2022. And these don't look annualized. And we're doing just the chained dollars. So May is 0.1%. Yeah, May is about that. June is 0.2. Yeah, 0, 0.2, minus 0.1, 0.3, 0.3. Yeah. These are not the annualized one. Actually, it's this table. It's not this one. Yeah, it's not this one. Although maybe some other, but yeah, these are okay. So we went from what? April, May, May. And then to September. Yeah. Those we check these. See? Yeah. Right. 0, 0.2. We have a little more decimal places. 0.1, -1, 0.3, 0.3. Yeah. Okay. So there's our press release, and that's all we can check because we didn't work on current dollars. We didn't work on any of this other stuff. And down here, there's something else. These are just revised, and these are in dollars. Income, personal income. So these are the changes in the previous month in July, August. It has percentages. So here on personal consumption expenditures, let's look at current dollars. We're down about 30 or 40 billion in July. Let's check that. Yeah, about minus 40 billion or so. Well, this is minus 15. And these are notoriously, these are notoriously, and the other one's 96. That's 37. It's the right directions. But, that's current. I'm sorry. We want chained. Yeah, we want chained. 15. Yeah, yeah. July 15. Good. 41, 37. Okay, but close. Yeah, so that 41 and then minus, that's all we can check. And the minus 15. Yeah, yeah. So those two, we looked at the table and they're there. And it's about. And this is point 0.3, change from the preceding month. Yeah, point 0.3 in July was minus a tenth. Yeah. So those work for us too. Yeah. Okay. So pretty good. So again, just looking at, right there, revised, 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 revised. Okay. So you guys can look through all these. Income we didn't do, income we didn't do, income we didn't do, income we didn't do. And this is a whole table here of this stuff. Yeah, we don't have the quarterly one, but here, since we're here, let's just check. So what are we doing here? This is PCE in February. Yeah, 1406, 083 to 14192. Yeah, thereabouts. The goods number 87 3 trillion 225. Yeah, I was just looking here. And this is 233386. Yeah, we got all that. Okay, and this, excuse me, this is change from preceding period. So this was February. $36, $25, $96, $30, minus 15, $37.44. Yeah, I mean, they're close, right? 21, 4, 22. Yeah, so September, right? If you just read down here, these are pretty good. This is September one. This, and then some of these may have changed or whatever from the past. And then there's the percentage change version of this. This is the index. It's this stuff, right? And February's 0.1. Yeah, February's 0.01. 25, 3. Yeah, good. 0.1. May, June, 0.2. 0.3. Yeah, we're pretty good. We're pretty good. Services 0.3, 0.5. Yeah. 0.8. Yeah, I'm just reading through. So yeah, there. So again, you can compare our computations with the press release, and we're pretty good with what we have here. Okay. All right, folks. So you had another. This is the third session, and this is the one that the folks, the Federal Reserve folks, reference this a lot. Okay, so just something to keep in mind. And then what are we doing here? You're going down here, and we'll hit. This is the index. So this is sort of the big drum roll with this. Now I'm not going to make a video tomorrow because we have class, and then Wednesday and Thursday we have class. Friday's mom hospital for mom, so I got to do that. Brainerd, we're talking about Brainerd here again. Let's see. We got through the PCE, we got through the shocks, and then will economists go too? You can never go. My cousin likes to say you can never go too far. Right? My cousin likes to say that. Yeah. So this will be another one, and then we'll look at Walmart a little bit now. And I want to do a little micro stuff with you guys too, if I can. Walmart, I'll tell you, I haven't. You guys aren't going to benefit from, but at some point we're going to have Walmart analyzed and ExxonMobil and Bank of America and these kinds of companies, and we want you guys to benefit from that. You're not going to benefit from that this semester, but at some point in the future, hopefully we can have a little bit of a micro discussion too, not just all the macro stuff all the time. All right, folks. Thank you very much. Let's say goodbye in person here. Okay. All right, folks. Thank you. It's always fantastic spending time with you, and we'll see you soon.